All right, let's start off with just the general macro picture. Obviously, markets have been volatile, topsy-turvy. What bearing has that had on Africa?
Well, absolutely. Markets have responded quite violently to the downward revision of growth prospects for the world, particularly obviously in the advanced economies, and the ongoing saga in the European Union in how to deal with the rising sovereign debt, as well as the impact thereof on the banks in Europe. Now, the main transmission mechanisms of this on Africa is actually through investor confidence and on commodity prices. So the asset classes that are facing downward revision as a result of the less benign growth outlook for the world is mainly through commodity prices.
Right.
So what we're seeing is that those markets that are heavily dependent on commodity exports, for example, like Zambia and some of the oil export markets, are seeing that they are facing some bearish market sentiments as a result of that uncertain prospect for commodity prices.
All right, we'll talk about commodities in a second. I just want to take you back to recent history, 2009 and absolute international turmoil, and Africa continued to grow. And we were told that we're immune largely because our capital markets are not internationally exposed. Not much has changed in 2011, and yet we still seem to be a little bit more vulnerable today than we were in 2009. Why is that?
Well, the transmission mechanisms in this uncertain time definitely remain the same. Obviously, the current state that we're in is not anything close to what we saw in 2008, 2009. We have not yet reached a state where global liquidity has come to a freeze, or that commodity prices have come off as sharply as they did in 2008 and 2009. So we still feel that the African markets still remain relatively protected from the global environment because the transmission mechanisms are the same. But that this time round, we are not yet in a position where we will re-enter into a global financial crisis. We are not of the view yet that we are going to hit a double debt recession. While we see global growth easing somewhat to perhaps something close to 3.5% in 2011, rather than the earlier foreseen 4.2% of GDP growth, we're still seeing that the commodity prices have remained relatively elevated, and that global finances still remain relatively liquid. And obviously monetary policy globally has remained very accommodative. And we're yet to see obviously how the policymakers in the US and the EU are now going to respond to the renewed challenges that are being faced. But equally so, we do believe that they will come to the table with new measures, although their room to maneuver is significantly smaller than it was in 2008 and 2009, and will offer some protection to global asset prices. So Africa will again remain relatively protected because the transmission mechanisms through the financial markets are, as you say, fairly limited because of the relatively small nature of our financial markets. As I said, through commodity prices, but also through investor confidence that may affect the foreign direct investment flows to Africa. We could see that impact still unfolding if the global outlook deteriorates further.
Those commodity prices that have also been subdued because of the volatility international has had significant bearing on exchange rates. We are seeing depreciating currencies, variations by degree, but that's generally what's happening. What can authorities do to just minimize the impact?
Well, we have indeed seen a fairly idiosyncratic response to that gyration in commodity prices. We've seen obviously that the managed currencies of the oil exporting countries like Nigeria and Angola have held up. We've also seen some of the free floating currencies such as the Ugandan shilling and the Kenyan shilling actually depreciate quite sharply. So if we look at the 10 most widely traded currencies, which include the three currencies I referred to earlier, the four currencies, sorry, we see that the year-to-date performance has been fairly negative. We've seen a depreciation across those 10 currencies. What will perhaps offer some protection this time around is that some of the commodity exporters have actually been able to accumulate significant amount of reserves on the back of the higher commodity prices and improved performance of production. So we've seen, for example, in the Zambian kwacha's case, that the central bank has significant amount of reserves, and it's reached phenomenal levels in the past year, and they've actually put those reserves to use in protecting their currency against volatility, and actually in the Zambian kwacha's case, avoided from moving beyond the 5,000 against the United States dollar. On the other hand, we've seen some markets use the interest rate mechanism and obviously increasing local market rates to offer some protection to the currency through making them more appealing to the international investor front and for the domestic investors to hold their currency.
Obviously, you've looked at about 20 leading and prospective economies. Just break it down into two. Let's talk about the three regional hegemons, Kenya, Nigeria, South Africa. We are seeing a bit of a sell-off in South African bonds. We are seeing a weaker currency. Nigeria, interestingly, that's where investors are going, into government treasuries. The yields are looking positive and attractive, but the currency is under pressure. In Kenya, not at all. The market lifting slightly, but generally government debt not attractive, currency not attractive, growth really subdued. What's your outlook?
Well, if we look at growth for both those countries, I think for Kenya's case, we're obviously going to see some support to the growth outlook from the domestic demand. But what we haven't seen is very significant confidence in its policy outlook. And I think that's been some of the reason for the lack of demand for its government treasuries. We've seen the currency obviously sell off in the recent past, and we've seen a fairly all over the place response from the central bank, in that obviously we saw it tighten, then loosen, and then tighten somewhat. And yesterday obviously we saw a further tightening, which was yet still remained below market expectations. If we look at the fundamentals of its external sector on the Kenyan front, we do see some reason for continued weakness in the Kenyan shilling, with some deterioration of the balance of payments. The current account has continued to widen despite the weakening of the currency, which therefore we believe has not been able to induce export growth. So that widening of the current account deficit, as well as some deterioration on the financial inflow sector, we believe will obviously give some more reason actually for the currency to remain weak.